Alright, welcome back to chapter 10. Okay. Today we're going to be looking at the second and third half, the other half of chapter 10 here. And we're going to be starting off with time value of money. Okay. So what is time value of money? Well, when we're talking about things like cash, right? We need to understand that cash, when we look at cash, right? Looking back in the past, a dollar was definitely much more valuable back then, where today it's not as valuable. So that's the idea here, is that when we look at money, right, we have to assume that it changes value over time. Okay? Now, when we actually look at a dollar, right, comparing to back then, a dollar is still technically a dollar, right? It doesn't really change by that much, because what we mean is, like, so if back then you used to buy bread for 50 cents, now bread is $3.50, right? That is what it means by the value of a dollar. But the actual essential idea of a dollar doesn't actually change. A dollar is still a dollar. It's still 100 pennies, right? But this is what we mean when we have to assume that with the dollar, it has to change over time. It's not like it used to be before. Okay, so exactly 20 years ago, things were a lot more, affordable. Okay, so what causes the dollar to lose value or just to change in value? Okay, it could be for many reasons, such as things like inflation, right, recessions, depressions, okay, as well as maybe an economic booming into society. Okay, there's many reasons to why the dollar changes over time. Okay, and that's what we are going to be looking at, is how do we assume what the value of the dollar is, either in the future. Okay, how do we make those projections and predictions in case we decide to invest in either a bond, or if whether we choose to invest in a loan? Okay, so in this case, when we're looking at time value of money, there are two methods or two ways that we can calculate how much interest is either collected or applied on a particular thing. So most cases for simple interest, right? Simple interest and then compound interest. The difference between the two is actually how much or how many times interest is calculated on a value of the dollar, right? So in this case, simple interest, actually you only are calculating interest once, okay, on a lump sum of money, right? Where compound interest is, you are calculating interest more frequently. And on this kind of idea, right, it's not based on a lump sum amount. You're adding on top of interest, on top of interest, on top of interest. So that's the huge difference between simple interest and compound interest. One of them is just one time on a lump sum value, and the other one is you're recalculating over and over on top of interest on top of interest. Okay, so what are we going? The examples that we're going to be looking at today. Well, for simple interest is any kind of typical like bond. Okay, where compound interest, right, the most visible seeing one that we normally see here in real life is a credit card, a loan. Okay, But those are just examples of what each one could be. Now, for simple interest, right, each one, right, is going to have some kind of calculation towards it. So simple interest is very straightforward, right? You're going to be needing a principal, interest, and time. Principal is going to be what your original investment is. So what is the original amount that you choose to what's your lump sum? What's the original amount that you start out with? Okay. Interest is going to be given in a percentage rate. Okay. And usually this percentage rate is an annual percentage. So APR for short, for annual percentage. But unless it's specified specifically like 2% per month, then you know it's 2% per month. But most cases, you should assume that all APR rates, right? If it says APR at the end of it, it's an annual percentage rate, meaning it's one rate that you calculate per year. Okay? In time, since the percentage is usually is an annual rate, normally you need to also consider time to also be in terms of years. Okay, if it's not in terms of years, you would have to convert it, okay, into years for you to be able to calculate this correctly. Okay. All right, where compound interest, right? We'll talk about compound interest in after simple interest, but they have the same exact criteria except for one difference. They have an additional number of times compounded, which is n, okay? Which is how many times a year or how many times, interest is calculated per year, okay? All right. So let's go ahead and dive into simple interest first. Okay? Simple interest, there's two formulas or two equations that we are looking at to calculate, right? Especially because when we look at time value of money, if we're going to invest $100, right? I want to know what is it going to be in the future, so future value, and I want to know how much interest I collect on it. So in this case, that's exactly what the two formulas are going to be looking at. You're going to be solving for interest, which is going to be your principal times your rate times your time. Pretty for short, right? PRTI. Okay, pretty for short. You're just multiplying straight across. So P times R times T equals your I, which is your interest. Okay? And your future value is going to be your principal plus your interest. Okay? FV equals P plus I. Okay? So let's take a look at an example here where, right, you bought a bank bond, okay, that's worth $100,000, right? And of course, the interest rate is 6% and it can be redeemable in 5 years. So here, I want to know how much is it going, if I buy this bond for $100,000, how much is it going to yield me in 5 years with an interest rate of 6%, all right? So how much is it going to increase by, right? So in this case, we have our principal, we have our rate, and we have our time, right? Our principal is $100,000, right? Rate is 6%, which if using simple math rules, right? When we're multiplying, you need to convert the percentage into decimal, which is going to move the decimal to the left 2. So in this case, 6% is equal to 0.06. Okay? And then we have our time in years. Time is already given in 5 years. So in this case, let's go ahead and solve for it. What is the principal times rate times time, or what's the interest going to be? Okay, so we're going to take $100,000. We're going to multiply that by 0.06, and then we're going to multiply that by the 5 years. Okay, so in this case, my total amount for my interest that I will be collecting is going to be a total of $30,000. Okay, 100,000 times 0.06 should give you 60, or not 60. Yeah, should give you like 66,000, and then you times it by 5 should give you 30,000. Okay. So straightforward calculator, you could do this, right? Straightforward. Now, how do I solve for the future value? How do I know how much my bond will be worth in 5 years? Simple, right? You take your principal of 100,000 and you're going to add your interest of 30,000 to tell you that at the end of 5 years, if you redeem the bank bond, right, your bank bond will be worth $130,000. Okay? So that is how we solve for simple interest. Okay? Now, what's the purpose of this, right? This is the purpose of if you choose to invest into a company, right? What are the chances that you're going to generate and yield extra income? All right. So this is where interest income is going to come into play, because here I gained $30,000 worth of interest because I originally invested $100,000. Okay. So that's simple interest. All right. Any questions here? All right. So let's talk about the difference between that and then compound interest. So again, compound interest is the same three components, right? Principal, interest times, principal, interest, rate. But the only difference is there is an additional variable, which is the n, right? Which is the number of times compounded. But the way that we calculate this, since it's not based on a lump sum money, right? It's based on where you're multiplying the interest, right? You're calculating the interest on top of interest on top of interest on top of interest. Okay? So in this case, right, when we look at that idea, right? Here, in order to solve for interest, it's going to be their future value minus your principal, okay? But in this case, I don't know what my future value is. So this is the formula for future value. Future value is going to be your principal times 1 plus your rate divided by the number times compounded, right? Up to the number of times compounded times time power. Okay? So in this case, we're going to be using exponents. Okay? What are exponents? Exponents is where you times the total value against itself, right? Now, how many times? It's going to be n to the t times, okay? So you're going to multiply the number of times compounded times time for you to be able to know how many times you have to be able to multiply it by itself, okay? Now, this is very difficult if you do not have a graphic calculator, but you do have Excel, okay? But if this is not, obviously, if it's not easy to do on Excel, that's okay, right? You guys can look up, a graphic calculator. I believe you can do it on the computer. If you have like Windows, the new Windows, you should be able to calculate this. But that's not the purpose of this class, right? The purpose of this class is to teach you using Excel. And I do teach it to you using Excel because that's the primary course of this class, right? Is to be able to use Excel to solve for this formula right here. Okay, but that's the formula here. If you want to know what the interest is, it's the future value minus principal, but you need to solve for future value first. And the future value is P times 1 plus R over N, close parentheses, N times T to the nth power. Okay? So, let's take another look at an example of the same exact scenario, except one criteria is different, right? Here, you're looking at buying a bank bond, okay, from that you're buying the bank bond that's worth $100,000, right? And the interest rate is 6%, and it's compounded quarterly, all right? And how much is it going to be redeemable in 5 years? Well, let's see. We have our principal of $100,000. We have our rate at 0.06. The number of times compounded. If it means that it's going to be compounded quarterly, right? Quarterly, meaning if you're taking a whole year and you're going to divide it in quarters, right? Every 3 months or 4 times a year, right? There's 4 quarters in a year, right? There's 4 quarters in a whole, right? And the time on this is 5 years. So that's exactly what we're going to be looking at. Now, we need to solve for future value first, right? So this is what we're going to do. This is the component that we're going to use on Excel, is that we're going to break it down like this. You're going to punch it into Excel exactly like this, starting with your equal sign, right? You're going to plug in P. You're going to have that asterisk, open parentheses, 1 plus, open parentheses, R divided by N, close parentheses, close parentheses. You're going to have that caret, open parentheses, N times, with an asterisk, T, and then close that parenthesis, right? In this case, if you have a calculator, you're going to punch it the same exact way. But remember, if you are calculating this on your calculator, right, so the phone cannot do it, all right, the computer can, or if you have a graphic calculator. But I'm not going to ask you to buy a $100 calculator for just one section of this course, right? You don't need to, right? Excel is more or less free, okay? So you're able to do that too, and you can also look up a graphic calculator online. They do have some available that you can use online, okay? So in this case, right, this is what you got to do. You got to plug in the 100,000. You're timesing it by 1.1 plus 0.6 divided by 4. Okay? And then you're going to multiply this whole entire thing by the nth power, which is going to be 4 times 5 power. So 20. Okay? To the 20th power. Okay? Because what it's essentially doing is it's taking this amount and it's multiplying it upon itself, upon itself, upon itself. Okay? Now, once you've done that, you should be able to get a total of $134,685.50. Okay? And here, how do I solve for my future value? Straightforward, my interest, straightforward, it's future value minus principal. So in this case, future value of 134,000 minus the 100,000, you're going to get a total of 34,685.50. And that's how much interest you've collected. Okay? Now, once again, what's the difference between simple and compound interest? You're not going to necessarily generate more. In this case, you did because it was compounded 4 times. Okay? So in this case, we had a difference of 4,000. But that's not always the case, especially depending on how many times you compound the amount, right? If you compound it more, then you're going to get more interest. But if you compound less, then you're just going to get less interest. And it also determines on the amount of time you have for it to be able to be to generate the extra interest, right? So in this case, right, that's how you calculate compound interest. And this is what a lot of banks do for credit card companies. This is what they do. They always compound you every single month, right? And they build the amount of credit that you owe, and then they calculate based on what you owe on top of what you owe. Okay? So same thing with loans, right? If you usually have an interest percentage of, usually it's really low, but it does add up over time. Okay. Okay. So how do we journalize this? All right. So first off, we have to journalize that when we began this, right, we purchased it for $100,000, right? Okay. Then 5 years later, right, on if you want to redeem it in 2015, then 5 years later, this is what you have to do. Or sorry, you purchased it in 2015 and you're redeeming it in 2020. 5 years later, right? And you want to redeem it. So in this case, this is what's going to happen. You're going to be recognizing something is, you're going to be recognizing that one, you're going to be obtaining money, right? You're going to redeem your bank security at $100,000, and you're going to recognize that you generated interest income for $34,685. So therefore, you should have a total amount of $134,000. Okay. Any questions here?
We don't put the like security. Okay. This is how do we just collect everything and we put it under bank security.
In this case, no, because again, right, if you remember the principle of historical cost, right? If you acquired something at $100,000, then it's going to stay $100,000.
So this is gonna be like credit or debit our account.
Well, in this case, right? Okay, so this is what happened, right? I went to the bank and I bought a bank bond for $100,000. So I had to spend the money to buy a bank security, right?
Mm-hmm.
Now this is a bank bond. Bank bonds increase over time, right? It's a means for you to save your money and to generate money off of this, okay? So in this case, it's what I have, a bank security. I bought a bank bond for $100,000. Now in 5 years from now, I want to redeem it. I want to cash it out. So in this case, when I cash it out in 5 years, it's generated $34,000 worth of interest. So not only am I getting back my $100,000, I get an additional income of $34,000. I made money off of this
when
bond.
we could do this one, like just in general, if we have like a company.
What do you mean?
Like when we could purchase account bond
Whenever,
anytime.
yeah, whenever you have enough money to do so.
This is for just who's having company, not individual.
Sure.
Okay.
Because in this case, remember, right? This doesn't apply to every single scenario, but this is what happens. You have to, what I'm trying to show you here is that because the scenario said that I bought a bank bond, right?
Mm-hmm.
How much is it? How much interest have you collected? Now, in the next one, I'm going to show you something that's a little more realistic, right? I'm going to show you what happens when you borrow a credit card or borrow a loan.
Okay. Thank you.
Okay? Because in this case, right, it's not always possible that, a company is going to be able to invest in bank bonds, right? So this is not as realistic as possible, but what I'm trying to get out of this is that when you do acquire those bank bonds and they do generate income, right, interest, right? How do you record it when you redeem it? This is exactly how you record it, is that you have to keep it separate, right? You purchase the original bank bond, right? What was your original investment, right? And then you're going to recognize how much money you generated off of that, which is your interest income. Okay. Right?
So in the exam, I lost between the debit or credit. It's like we got it or we just lost it, the money. It's just
You're not gonna, okay, let's go ahead and say, look at this, okay? A bank security
mhm.
is an investment, right? Do you know what a bank bond is?
I'm not familiar with like
A
this
bank
is the
bond
first.
is where you buy something and
Mhm.
in 10 years from now it earns money, right? So it's like a retirement. Like you heard of an IRA, right?
Yeah.
If you buy $50,000, right, in X amount of years, it's going to be 80,000 because it's an IRA. It's a retirement plan. You put money in the bank, right,
Uh-huh.
and you're hoping that it will save money and collect money for you, and you don't have to touch it.
Oh, okay, okay, okay. And when we put this money, it's like after 10 years, we could be pull this money and
Correct,
like
correct,
get the
correct.
income.
So that's exactly what this is. So this is a bank security, right? I'm buying a bank bond that's worth $100,000. So I am investing in to save $100,000. But if I don't touch it for 5 years, how much is it going to generate interest for me? In this case, right? So here on January 1st of 2015, I purchased a bank bond for $100,000, meaning I had to spend the money to purchase an investment. Okay?
So yeah, I understand now.
So let's say,
Thank
for
you.
example, I put it into a savings, right? I put it into an IRA. Then 5 years later, right? The rules here is that it's going to generate 6% interest and it's available to be collected in 5 years, which that's why we did the calculation. So once we did the calculation, we found out that we actually generated $34,000 extra money. And when we redeem it, we get the cash money. We get our money back that we invested of $100,000 plus we earned $34,000 on top of that.
So our job is collect how many percent we got after like, for example, 5 or 10 years.
And sure. I mean, in this case, right? This okay. In this case, this not is not as much as a what do you call it? A great example because in reality, if you have the money, then you invest into it. But if you don't, then you won't. But I mean, I'm going to show you a more realistic type of example. I'm going to show you because, again, when you open up a business, you're most likely going to have a loan and you're most likely going to have credit cards, right? That's more likely than buying a bank bond. But in this case,
Okay.
it is not your job to to keep an eye on this bank bond. Your only job is to see where did this money come from and how do I journalize it. Okay, so in this case, where did this money come from? Well, I bought a bank bond, right? I invested money into something and now I'm expecting a return. Or a return on investment. So in this case, my return on investment is I generated $34,000 on top of what I originally invested. Right? Think of it like stocks, right? If you invested 50 cents into a company, right? And then it goes up by $1 and I decided to cash out, then I would have cashed out that I bought a stock that originally purchased at 50 cents and it generated 50 cents of income, interest income. Is this any clearer?
Yes, thank you so much. I understand. And maybe when we got like another exam, we will be like understand more.
Okay, well, in this case, that's adding money. That's interest income. Well, in this case, well, what if I give you an example for a typical loan or a typical credit card? Because in this case, this is definitely something that you will see in the future, whether it's right now in your personal life or whether if you do open up a business, what are your options if you choose to open up a business loan or take a small consumer loan, right? So in this case, I'm going to show you how is interest actually calculated, especially when you have loans or when you have to pay your credit cards off, and how these payments actually affect the overall principle of any loan. Okay, so anything for a bank or a business loan, okay, or credit card, credit card companies, right? They're going to be charging you interest, and this is how it's actually calculated. Okay, so here's an example here where on January 5th, right, you borrowed a bank loan for $10,000, okay? And it has an interest rate of 4.75%. And okay, and it's compounded every single month. So that means it's calculated interest every single month. All right, and the bank approves that the loan is expected to be paid back in 5 years. So in this case, you have a 5-year loan for $10,000, okay, with an interest rate of 4.75%, and it's compounded every single month. So if I were to calculate this, right, I go ahead and calculate my figures and I'd get this number. Now, how does it actually calculate? Well, let's take a look, right? Let's just journalize it that on January 5th, I decided to get a bank loan, right? So in this case, I received $10,000 cash, and now I owe the bank $10,000, right? Now this is how it is actually calculated, right? If you break it down, the formula of the compound interest, and you break it down per month, this is exactly how it will look, okay? Usually when you acquire your loan on the first month, usually the first month there is no interest, okay? You don't get charged interest until the following month, right? Because in this case, right, you just borrowed the money, right? It hasn't had time for you to accrue any time in between for you to collect to be charged your interest, because in this case you just got it. Okay, it starts the day that you get it, and then and then every single month it starts calculating. So in this case, the first month of January, you're going to get charged 0 interest, okay, until February rolls around. So in this case, this is exactly it, right? You started with $10,000. You're going to get charged 0 interest on the first month, right? So therefore, your current balance is going to be $10,000, and you didn't make any payments yet, and so that means your net balance is going to be $10,000. Okay. So because when February rolls around and we need to figure out what my interest is, right, for the next following month, right? This is how we're going to calculate it. We're going to take our interest percentage of 4.75%. Since we know this, right? If every single payment is going to be done at every single month, right? Since 4.75% is an annual percentage, again, it's an APR. That's how much interest per year you're going to be collecting. In this case, I need to know how much per month. So what I'm going to do is I'm going to take that 4.75 and divide it by 12 months, because in this case, right, that is where the interest rate is going to be applied. Because in this case, what's my principal? Well, right now, I still have $10,000 that I owe. So that's my principal. Now, in this case, I need to figure out how much it's going to be charging the interest per month. So in this case, that's exactly what 0.475 is divided by 12. It's going to give you 0.03958. Okay? So once this gets there, right, that's how much interest you're going to be compounded per month. Okay? That's how much you're going to be collected per month. Since this interest gets calculated every single month. So in this case, right, 0.03958, which is the 4.75 divided by the 12 months. Okay? So then that means I'm going to multiply across to get me a total of $39.58. Okay, so that's how much interest I'm going to be collecting for that month. And then it's going to be tacked onto my current balance, right? And if I choose to make a payment, then I'm going to show you how it affects it. So in this case, I've accrued interest. So now I owe $10,039.58. So what do I do here? Well, if I choose to make a payment, let's say my interest or my payment, right, the bank has already figured out this number for me. The bank has figured out that I have to pay $187.57 every single month for the next 5 years in order to pay off my $10,000 loan. Okay? So in this case, this is the amount that I need to pay. Well, if I paid $187.57, right, how much is it actually going to go to my principal? Because the rule of thumb here is that this is why we calculate the interest here, because now I accrued $39.58. Every time you make a payment, right, the rule of thumb is you always are going to always pay the interest first, and then every dollar after that is actually going to go to your principal. So this is why oftentimes when you end up trying to pay your loan off, right, you're trying to figure out why is it taking you so long to pay off your principal. It's because you're paying off the interest first. Now, some banks too, right? They've already calculated this way beforehand. That's how they know you owe $187.57, right? And this is what I'm teaching you. I'm teaching you how to get that number. So in this case, when you get this number, what they do is they divide it by the number of payments and say, hey, you owe me $187.57. Some banks, right, they make you pay nothing but the interest first. So they don't even have to calculate this because it's already been calculated. So what they do is they make you pay all the interest first, and then they start making payments towards the actual principal, right? And if you did not know this, right, you can actually call the bank if you choose to make an additional payment, not the first payment. The first payment covers interest always. Second payment or any additional payments to your loan, you can call the bank and say, hey, I want this money to actually go towards the principal. And it will go towards the principal. Okay? And that's how you could pay it off quicker, faster, and things like that, right? But in this case, I'm making a payment of $187.57. Okay? So in this case, this is the normal way of doing it, right? I'm with that payment of $187, right? Only a portion of it's going to actually go to the bank loan, right? Because in this case, the reason why we had to calculate that monthly interest is because this is what we're going to be paying off first. And then we can say, okay, I wrote my check out. So first thing we have is $187, right? The interest for that month, which we solved for, was $39.58. So in this case, right, when I make a payment, I'm paying for my interest first. And then whatever excess amount, which is, so whatever 187 minus 39, it's going to give me $147.99. this amount is actually going to go pay off my actual principal. So at the end of the 60 payments, right, you are going to be split between interest and your actual principal. You're never going to be paying your entire principal off. And that's where the bank that gets you. This is where they trap you into borrowing money, because this is how they make money. Is that they're making you pay them first, and then you're going to pay the actual loan itself. So that's why it is very tricky, and you have to understand, if you choose to do this, right, this is what you have to understand, is you're always going to constantly be paying the bank their money first before you're actually paying what you owe. Okay? So that's what happens here. If you're gonna make the bare minimum of the $187.57, this is what's gonna happen. Okay. So I make my payment. So now my principal is now, or my current balance is now $985, $9,852.01. And every single time, so if you choose to pay the bare minimum, right, you're never going to pay your principal, because if especially for credit cards, right, they say, oh, your minimum payment is $25, and if you pay just $25, you're paying the interest. You're never actually paying the principal. Okay. So make sure you do understand that. So that's why you'll never ever pay off your credit card, because if you choose to pay the minimum, you're only paying the interest of what they charge you, and never actually to the principal. So in this case right here, you get $9,852.01, right? And that amount right here is what's going to carry over for the next month. So what do payments do? They just cover the interest, and they only cover a small portion of the principal. Okay? So if I were to do this one, right? This is what I said, when you carry this value over. You're not going to start at 10,000 again. You're going to start with $9,852.01. And this is where you're going to calculate your interest once again. And this is where every single time you keep, having to calculate this, right? This is what compounded means. It's being calculated upon itself, upon itself, upon itself. So especially if you have a student loan, right, and you get forbearance, or you get the time on it of it to be extended, right? Since you're not making any payments every single month that it's accruing interest, it's going to be calculated interest on top of interest on top of interest on top of interest. So if I didn't make a payment to this loan, right, that means my next principal would have been based on the 10,039. So this is what I mean by compound interest, is it's multiplying on top of itself over and over and over again. And this is where you get trapped too, because not only are you paying interest once, you're also getting multiplied the interest on top of the interest. Okay? And this is where the bank will get you. Okay? So in this case, there you go. I calculated my second one here. So I got $39 even. So therefore my new current balance is this here. I'm going to make another payment, and so on and so forth, right? So then you're going to go through the cycle over and over and over again. Okay? All right? Any questions in regards to simple interest and compound interest?
No, I don't have.
Okay. So let's go ahead and dive right into our exercises here. Starting with question number 1. Okay. So we're going to do some simple interest here. Okay. Number 1 says that if you bought a bank bond worth $225,500, okay, the simple interest rate is 7.45%. and can be redeemable after 3 years. How much interest will you be collecting at the end of 3 years? So in this case, how do I figure this number out?
We do like the 2500,
Okay.
and we put the rate of the 7.45.
Okay.
We like buy, uh, and it's gonna be give us the number, correct?
Yes, all these numbers are be given, yes.
Okay. Do you want me to give it to you?
Mm-hmm.
Okay. Two. I got 1,679,975.
What did you do with the 3?
Oh, where is the three? It's 7.45, right?
Where is the 3? The 3 is under time. What do you do with the time?
Oh, okay. Um, 3 years is gonna be give us three by 12, correct?
No, I'm not
Mm.
asking you. No.
Mm.
I got 5. No, never mind. That's not right.
All right, do it again. Okay, so simple interest. To solve for the interest, it's principal times rate times time.
Yeah.
Oh, okay. Then maybe it is right. So it'd be. Is it 5 million?
Okay, not 5 million. No.
It's 5. It does. Yeah.
So again, rate is going to be 0.0745.
No. Okay.
Mm-hmm.
0.07. 50,399.25.
Okay, good. So this is how much interest I've collected in a span of 3 years. So in this case, what's my future value going to be?
$275,899.25.
Good. So this is what I'm trying to ask you here. So in this case, right, I bought a bank bond for 225,000, right? And it's going to give me 7.45% interest in a span of 3 years. How much interest did I collect? So in this case, this is simple interest, right? We're just multiplying us the rate by the simple lump sum by the time. So in this case, I get $50,000 worth of interest, and the total that I can redeem it in 3 years is $275,895.25. Good. Okay. So then let's look at scenario 2, where I'm going to look at a bunch of examples. So I need to solve for all of this. All right. Starting with the first one, if I have a principal of $15,000 with a rate of 5.12%, so 5.12%, and it's 5 years. What's my total interest I'm going to be collecting in 5 years?
So
3,840.
Let's see. So 15,000, right? You're going to multiply by 0.512, and because it's in 5 years, I'm going to times it by 5. Should give me 3,840. Yes. So how much is it going to be in 5 years?
18,840.
Right? Principal plus interest is going to give you 18,000. Okay? If I decided to have an original investment for $4,521.50 with an interest rate of 2.45%, and it's going and the time length on this is going to be 90 days.
so
90
I need your
days.
help to teach me how do I collect it, because when I go, like I do 4, 5, 21, 50 by 0, 2.45, correct?
0.0.
Oh, point 0. This is okay. Now 4, 5, 2, 1, 50 by 0, 2.45.
You don't put the point there.
Oh no, I got 11,077,675. Is it correct?
No, because what did you do with the time?
This is what we got, and after this, we need to collect the time. Like for example, 5 years, fee, by 12. Correct?
No.
How?
Once again, let's do the first one again.
Mm-hmm.
The simple interest is just principal times rate times time. Okay? It's already in 5 years. There's nothing you need to do except for just figure out the number here. So you're going to take your principal. So it's punch in 15,000. Okay?
Mm-hmm.
What's the rate?
1 second. I just collected. 1,106,175. Do we multiply? Do it by 5? Just 5?
Okay, which one are you on? I want you to do this. Okay, erase everything in your calculator.
Okay.
15,000.
15,000. Okay.
Okay? You're going to multiply it
Mm-hmm.
by the rate.
5.12.
No, the rate needs to be in decimal form. That's
Okay.
percentage form.
Mm-hmm.
So it is
Then it would be 5.2.
no
Mm. 0.
0.0 okay. It sounds like you need to do a math lesson here.
Mm-hmm.
5.12%. To convert that into decimals, you're going to move this little dot right here in next to the 5. You're going to move it
Mm-hmm.
to the left twice.
Okay, it's gonna be 0.
It's going to be 0.0512.
0.05.
512. It's 12. It's 12.
Okay. 15. Okay. multiple by 5. Okay, 0, 5, 12. Okay, I got 768.
And that's what I keep telling you. What did you do with time?
We do it by 5.
Yes.
We got 3,840.
Good.
Oh, okay. Now I understand. Thank you. And what is the future? How do we get to the future
You
with
tell
800?
me. How do you solve for the future?
The future is gonna be okay. Simple. Future B like the principal
Okay.
with interest.
Okay, so then there you go.
15. Oh, this is very easy now. The 3,840. Okay, here we got 15, 0, 0, 15, 0, 0, 0. Okay, then 3, 8, 4, 0, 0. We got 54, 90.
I don't know where you got that number, but you were adding way too many different numbers to each other. 15,000 plus 3,840. You can't do that in your head?
Oh yeah, it's 18. Okay. Yeah, why I got different number, I don't know.
Okay.
Okay, 15 with the 3. Okay.
Okay.
Mm-hmm. Thank you. Now you teach me good math.
Okay. All right.
So we just got the future value and we do it and simple interest. Whenever they ask us in a question, like we just got this form and we could solve it, right?
I will be giving you this table, the exact table that says the principal, rate, and time.
Okay.
And I will ask you, how much interest will be collected in 5 years? How
Mm-hmm.
much will the bank bond be in 5 years?
So in 5 years we don't go like five but multiple by months. No,
Am
we
I
go
asking you for month? Am I asking you per year? I
for year.
Okay, there you go. I'm not
Mm.
asking you how much it's going to be in 1 month.
This is for like for my real estate class is very good. I was like having trouble. Now I understand it. Okay, thank you.
Okay. Now let's take a look at the second one.
Mm-hmm.
Right? If I started out with $4,521.50 with an interest of 2.45%, and it's going to be redeemable in 90
90.
days.
Mm-hmm. No. 4, 5, 2, 1, 50. Okay, by 2.45. Okay, how much we got here? 4, 5,
So
2.
for the 90 days, do we just multiply by 90 or is it quarterly?
What's the rule? What should my time be in?
90.
Well, what should my time be in?
Oh, quarter.
Not quarter.
Um,
If my interest rate is an annual percentage, what should my time be in?
annually.
It should be in terms of years. Good. So, how much is 90 days in terms of years?
3 months.
In terms of years.
Oh, quarter.
Okay, good. So, in this case, we understand that, what is it? That 1 month
Mm-hmm.
is
30.
equal to 30 days, right?
Mm-hmm.
And we have, in this case, we have 90 days. Okay, equaling 3 months. Right? So then now we need to solve for how many is that out of a year. Okay, in this case, we know that 12 months equal a year. So in this case, this is 3 months out of 12 months. So that's going to give you a quarter of a year. Right? 3 divided by 12 is a quarter of a year. Or you can just keep it in your calculator as 3 out of 12. That also works too. Okay, so in this case, since it's a quarter of a year, that's exactly what I have to put in. I have to convert my time into terms of years. So in this case, 4.521.5 at 2.45% for a quarter of a year. How do I calculate this?
So we would do 4,521.50 times 0.0245 times 0.25.
Mm-hmm.
But then I get 27.69.
Good.
Is it?
Mm-hmm.
Oh, okay.
Because in this case, right,
I'm like, that's it? $27.
it's because I only have it for 3 months.
Right. That's true.
If you had it for a longer length of time, and it's on top of that, the interest percent is only 2.45%. It's going to be very low.
I see.
Mm-hmm. So no, that's correct. So that means, what's my principal going to be then?
4,520. No, 29.39. 19.
Mm-hmm. It's okay. Okay. Good. So then let's go ahead and figure this out. If I have something that's 384,125.22 at a 7.89% for 6 months.
17,093.57.
I don't know if that's correct or not. No, I got 15,000. So let's see where you went wrong. So in this case, 384,125.22. We're going to multiply by 0.0789. Okay? 6 months is going to tell me that's half a year. Okay? Are you punching in the calculator with me?
Yes.
Okay. So what do you get for the interest?
15,153.74.
Okay, and then what's your future value going to be?
399,278.96.
Okay, good. So because you guys don't have calculators here, and I'm gonna assume Excel. Okay, you know it, you don't. That's okay. But I'm gonna show you how to be able to compute it into your computer here, on how to use the Excel to solve for the future value as well as the interest for compound interest. So as you can see up here, I give you the formula up here as well as the interest up here as well. Okay. So in this case, right, it says that you were approved for a bank loan for $5,500, okay, with an interest rate of 6.25%, okay, and it's compounded monthly, okay, meaning 12 times a month, okay. How much interest will be collected if you paid or if you decided to pay it off in 5 years, okay? So this is what I need to do. I need to solve for my future value first, right? My future value is going to be my principal, so the 550,000, okay? It's going to be multiplied, right? And this is what I have to do because Excel is very straightforward, right? You have to tell it the order that you want to calculate it in. So the parentheses, if you guys remember from math, right? PEMDAS, right? Parentheses, parentheses, exponents, multiplication, division, add, and then subtract, right? That's the rule of operations. So in this case, I want it to multiply the rate divided by the n first, and then I want it to add the 1, and then it's going to use the exponent to figure out the rest of the numbers. So you have to punch it in exactly like this for it to work. Now, Excel is also very sensitive to your typing as well, okay? You have to remember, if you put in one parentheses, you have to end the parentheses, okay? If you don't, it's gonna go all over the place and it's gonna show you that you have an error, okay? Or a, what do you call it, a text error, okay? So in this case, there you go. I have my principal in there, right? I'm going to multiply, right? I'm going to open my parentheses first. 1, okay? I need to add, and then I'm going to go ahead and open my parentheses one more time, okay? Notice this. It color codes your parentheses so you know how many parentheses you have and how many you need to end with, okay? So what do I want first? I want my rate of 6.25%, which in this case, I put as 0.0625, okay? And I'm going to divide this by my number times compounded, which is 12, okay? So I'm going to end this parentheses, so there's my first parentheses, and then I need to end it with my second parentheses because I have 2 parentheses here, okay? What I'm going to do now is I'm going to put it in an exponent. Okay, so I'm going to have the up arrow key, which is going to be your number 6 key. Okay, so you're going to hold shift and press the 6 to get that caret up there. Okay, and that's going to be triggering my exponent. And now I'm going to do another parentheses because in this case, I want it to calculate what n is. N is 12. And we're going to multiply it by the time, which is in 5 years. Okay? End my parentheses, and then press enter. And I should get $7,511.51. And To figure out how much interest that is, you take your principal, you minus your, you take your future value, you minus your principal. So if this is how much it's going to cost me in the future, $7,511.51, and I started out with 5,500, I just simply subtract the two, and I'm going to get a total of $2,011.51 worth of interest. Okay? And that's what I'm going to be collecting over or paying in the span of 5 years. Okay? And this is where a lot of the banks do. They calculate this number out for you, and they simply say, okay, since you're going to pay it off in 5 years and you're going to make your monthly payments, so what are they going to do is they're going to take this and they're going to divide it by the number of years times 12, or if you do monthly payments, right, 5 times 12 is 60 months. And then so that means you're going to end up paying, that's wrong. You're going to take your interest, right, and you're going to divide it by 60. So what's 5? 5 times 12 is 60. There you go. You're going to pay $33.53 per month for interest. And that's how they calculate it for you. And say, okay, if this is your total amount that you owe me, right? You owe me a grand total of $7,511, and you divide that by 60. That means your monthly payments are going to be $125.19. That's how they figure out your monthly payment, is that they already calculate the interest already. All you have to do is just pay it. So in this case, they already charge you they already charge you the interest. So in this case, every monthly payment, you're going to end up paying, $33 to the interest, and then the rest is going to go to your principal. All right? And that's how this works. Okay. So that means in the next one here, let's practice that Excel formula once again. Okay. If I decided that I have $15,000 with a 5.12 interest rate, and it's going to be compounded quarterly, so 4 times a year, and it's going to be the time length is going to be 5 years. Ken, this is what you're going to do. Principal of $15,000. You're going to multiply 1 plus rate is the 0.0512 divided by 4, okay? Because that's how many times there is. Okay? Caret, another open parentheses, okay? N, which is 4 times time, which is 5 years, okay? You should get a total of this 19,344. So let me put this in dollar form so you can see it. Okay? All right, that's how much your future value is going to be. So that means how much interest should I be collecting off of this? Right? Can someone calculate this for me? What's my principal going to be if my future value is $19,344.84? How much interest is this going to yield me?
We do a future value minus the principal, correct?
Mm-hmm.
Okay. gonna get 4,344.
Good.
Yes. Mhm.
Good. So let's do the second one, right? Let's redo the formula once again. So equal to activate your formula. Your principal is 4521.50, right? You're going to multiply that by 1 plus rate of 0.0245 divided by your number of times compounded, which is 2. So that means you're going to get charged the interest twice a year. Okay? And then you need to figure out what the exponent is. So twice a year times 90 days. We figured out what 90 days was. 90 days gave you a quarter of a year. Okay? So you should get a grand total of $4,549.11. So in this case, how much was my interest? If my future value is $4,549.11 and my original principal was $4,521.50, how much is my interest?
$27.61.
$27.61. Okay. And then let's do the last example here, right? Your principal was 384,125.22, right? You're going to multiply that by 1 plus the rate of 0.0789 divided by number of times compounded. This time it's 3. That means every 4 months you're going to calculate calculate the interest. Okay. So 3 times 6 months gave us half a year. Okay. So in this case, you get a total of $399, $378.16. So what should be your your interest? How much interest did you collect? Go ahead.
15,252 with 94.
Okay. Now this is compound. Now, if you actually notice, this was the same exact scenario. The only difference is we added the number of times compounded. So let's actually compare. So this is your simple interest. So let's look at the first one. You got for compound interest, you got $4,000 dollars of interest. Where in this case, right, your simple interest, you only got 33,840. So slightly little better, especially if you're doing a bank bond, right? Slightly better here. Now you also got $27.69 for the simple interest, where your compound interest actually gave you less. It gave you 8 pennies less. Okay, difference not that huge, but again, this is what you collect in 3 months, so it makes sense. Okay, and then the last one here, you got 15,252 compared to your simple interest of 15,153. So you're off by a whole $100. Now, does it matter which one you do? Yes and no. This again, if you're doing simple interest, it's only multiplied by the interest is only multiplied by 1 time. But for your compound interest, it just really depends on what your interest rate is and how many times you actually get compounded. Okay, because if you get interest multiplied a lot more often, then you're going to collect it a lot quicker. But in terms of what you're looking for, you should look at your percentage. Your percentage is going to ultimately give you the bigger amount and the length of time as well. If you have it for a short amount of time, you can only hope to get so much. Okay. All right. Last one here. Let's do another example here of a loan. Okay, so here, right, we're gonna journalize the bank loan from example number 3. Okay, and this bank loan was made on June 1st of 2020. Okay, and then of course you have monthly payments are variable. So here I give you the what happens if you pay more. Okay, situation, and it's due every first of the month. Okay, and of course there are no hidden fees and 0% or 0% APR. So in this case, you get charged interest immediately. All right, and of course the bank loan is effective immediately. So that means you should start accruing interest the following month. Okay, journalize the first month of payments. Okay, so first 3 months. So let's take a look here. First off, we acquired our bank bond, right? Or sorry, our bank loan on June 1st, right? So here it is, question number 3. So your bank loan is $5,500 with an interest rate of 6.25%. And of course, it's for 5 years, right? Which we already figured it out, right? This is how much it is at the end of 5 years. Okay? But I want to know what the breakdown is. If I'm making my monthly payments, how will it affect my bank loan? Because at the end of the day, I'm still going to end up paying $7,511.51 worth of interest, right? Or, well, I meant like an overall. You're going to pay $2,000 worth of interest, excuse me. So then in this case, right, that's what I need to journalize. I need to journalize that I acquired a bank bond worth $5,500. Okay, so date says I made the bank bond, okay, on June 1st. Okay, so how am I going to journalize this? If I acquired a bank bond, I'm sorry, a bank loan, how should I journalize this? If I got a bank loan, what does that tell me?
I have interest.
No, right now we just got the bank loan. I'm asking you. I just got the bank loan. How do I journalize that?
Principal.
No, this is journalizing. How do I journalize that I got a bank loan?
Was it bank some like a S? So I forgot what it was.
This is a bank loan. The loan.
A loan, so checking account.
Yes, right? When you borrow money, you're going to get money out of it, right? So you should be getting money in your checking account. Okay? And you have a bank loan, right? When you acquire a bank loan, you don't accrue interest until afterwards. So how much was my bank loan for?
5,500.
Okay. $5,500. Okay, so I just got a bank loan for $5,500. Okay, so usually on the first month, right, we usually have zero interest because it's not calculated until July. Okay, but in this case, let's go ahead and figure out the first line here because again, you don't accrue it in June. But after June passes, right, and you make your payment in July, how does that affect your entire payment? So in this case, right, let's figure out what my July statement's going to be for. Okay? So June, right, is 5,500 right now. That's your principal, right? That's what you started out with. My interest rate is 6.25%. How do I know how much that's going to be per month?
Multiply by 12.
Not multiply.
Divide.
Divide, right? You're going to take your 0.625 and you're going to divide this by 12. Okay? So then you're going to get roughly about 1% per month. In this case, I'll just extend it so you guys know that this is your percentage rate. Okay? And it's going to apply every single month. Okay? So that's how much interest you're going to be calculating every single month. Now in this case, right, simple, straightforward, right? How much interest will be for this month of July? For the month of July. Or for the month of June, since you got it June 1st, at the end of June, how much interest will you be collecting?
$28.65.
I think it's a little higher than that. So 5,500 times 0.0052083, if you want to go as far as that. I believe it's like third. Oh yeah, no wait, you're right. It is 28.65. Okay, good. Okay, so that means your current balance. Okay. So that means your current balance is going to change, right? Because now you need to send the bill including the interest. Okay? So in this case, right? So that means my current bill is going to be 5,500 plus my $28, and this is going to be your current balance in here. So in this case, you don't need your new balance there. Okay? Okay? So if I decided to make a payment, right? In July, I decided to pay $200. Okay? If I decided to pay $200, right? How do I journalize this payment that I'm making here? So it's July 1st. How do I record making a payment here to my loan? If I'm going to make a payment of $200.
Loan payment.
Okay, good. Loan, bank loan. What else do I need to recognize?
Interest.
You have to also recognize that you're paying the interest expense. Okay? And last but not least, how are you going to make a payment? You're going to use your checking account. So in this case, I'm going to make a payment of $200. How much of that $200 is actually going to go to interest? What did I calculate my interest to be?
$28.65.
So how much money is actually going to go towards my principal? If $28.65 goes to my interest,
$171.35.
yes, that means only $171 is actually going to go towards your principal. So that means, right, my new principal, right, if this is my current balance, right, of 5,528, right, but I end up making a payment of $200, then that means my new balance or my principal that's is going to be, actually no, this is what you're supposed to put here. So your new balance, right? If you make your payment, right, you're gonna subtract your 200, right? It's gonna give you a new balance of $5,328, and then you're gonna carry that over into your principal. So they do go in the same spot, okay? So that means my next time that I calculate my interest for the month of August is going to be slightly different. So in this case, right, I'm starting out with $5,328.65, right? And now, how much interest will be charged for the month of August? Or for the month of July, excuse me.
I'm confused. How did we get the 5,300?
Okay, so in this case, right, I calculated my current balance to be the 500, the 5500, right? Plus my interest, right?
Yes.
So that's my current balance. Because I made a payment of $200, right? That would change my current balance to my new balance because I paid $200.
Okay, I see. Thank you.
And because I made that payment of $200, that means that becomes my principal for the next time I need to calculate this. So this is where compound interest, right? This is where we have a new principal every single time. This is where you're multiplying it on top of each other, on top of each other, on top of each other. So again, if you're making a bare minimum payment, then you're only going to be paying the interest off first, right? So in this case, let's calculate this right here. What is going to be the interest for July? If my principal is $5,328.65, right? What is going to be my interest for the month of July?
So we need just to minus the 250 from the 532.8, correct?
Say that again?
We need to minus the 250 from the 5,328.
No, no. We're on the month of July. We need to figure out how much interest there is.
2775.
Right? You're gonna. So what she did here is what she took the principal and multiplied it by the interest, right? And that's gonna give you $27.75. So again, when you receive your statement for the month, right, you're not going to see this $27, right? You're not going to see this $2,328. You're going to see a combination of the two, right? You're going to see your current balance is going to be excuse me, 5,357. So this case 56. So in this case, right, I'm taking my principal of what I currently owe right now, right? Because I already made the monthly payment in July, right? This is my July interest now. It's going to tell me that I owe this much and that this is my current balance, right? This is it in grand total. I now owe $5,356.40 because of the $27 interest, right? But if I decide for August, right? Let's say August, I'm going to make a payment in August of $250. Okay?
It would be 5,106 with 40 cents.
Good. Right? Because in this case, when I make a payment, I'm paying off what my current balance is. But in this case, right? Um, in this case, right, this is how you figure out what the new principal is and what you have to keep recalculating. So in this case, let's go ahead and journalize my payment that I made on August. Okay? So I'm gonna recognize I'm gonna make a payment in August. Okay, so August 1st. But this time, I know for a fact that I actually made. Oh, I made it too close. Okay, but at least in August, I know that I made a payment of $250. Okay, how much of that $250 is actually going to go towards my interest? Right, I calculated the interest for the month. Okay, so right now, I'm going to pay $27 worth of interest because that's how much interest I collected that month. All right, so I'm going to pay the interest first. And then how much money is actually going to go towards my actual loan? How much money is actually going to go towards my loan?
$222 with 25.
Good, right? So then, right, you already saw for how much your new balance is after making your payment of $250. So that means my principal is going to start with, when I calculate my interest for August, is going to start off with $5,106.40. Right? So then, how much interest is going to be charged for the month of August? $26.60. So therefore, my new statement current balance, right, is going to have my principal plus the interest I just racked up for the month of August. Okay, so therefore I get $5,133. So therefore, let's this time in September I'm gonna make a payment for $300. Okay, so September. Okay, we're gonna make a loan payment. Okay, and this time I know for a fact I'm gonna make a payment of $300 this time. So in this case, since we calculated it, we have a total of $26.60 that's going to interest. Right? So therefore, how much money is actually going to go towards my principal? Oh wait, hold on. My interest is supposed to be this number here, the 2660. Okay, so that means $273.40 is actually going to go towards my principal. So then you're going to do the same calculation here. You're going to calculate that you made a payment of $300, so your new balance is going to be $4,800, and then of course you just plug this number in and solve for the interest that you're going to be charged in September. Okay? So any questions in regards to this? I only asked you to do 3 payments. Any questions in regards to this? Now, if you drag this all the way out, at the end of, what is it, 5 years, 60 months, so 60 payments, you're going to end up racking up a total of $2,011 worth of interest, which is exactly how I were to solve for the other one. Okay? Any questions?
Mhm.
Okay, so this is real life learning, right? This happens in real life where you do get a business bank loan, or even a student loan, or whatever it is that you guys, get loans for, right? This is what happens, and this is how you are able to break it down yourself, right? Because they're gonna say, hey, if you're gonna borrow this much money, this is what you owe me. And if you actually take a look at that number, they already calculated the interest already. It's already included. Okay? If you choose to pay more, then yes, you'll pay less interest the next time around, but that's because you end up paying more to your interest, right? But at the end of the day, they've already calculated the interest and they're just collecting it from you. Okay? All right? Um,
So they already collected interest and then are charging us more interest on their interest.
no, no, no.